All right, welcome everybody to week 2 of Finance 444. Tonight our agenda is to review a few things from last week. Then we will cover material on taxes, and we'll also be covering some material on financial products, savings, and bank products. I will say that if you come away with some information about taxes and bank products tonight, you will be ahead of the game as far as most people don't understand taxes. That's why we pay corner people who have had like 2 hours of training to do taxes for us. And as far as bank products are concerned, we go in and expect a banker to tell us what we need as opposed to telling the banker what we need, which would be a better way to approach our banking relationship if we already knew what it is that we were looking for, as opposed to going in and having them have to tell us what to do. So it'd be a great thing to pick up some basic information on tax, deductions, credits, things like that, understand the tax system, and then also to understand better banking and financial products, basic cash management products that are out there. So I'd encourage you to read the ebook, chapters 3 and 4. We'll also tonight, after we cover the slides on chapters 3 and 4, spend some time making sure that you're ready for the test this week. Just 10 questions, 2 comprehensive ones. The rest of them are on tax and cash management products, so from the chapters this week. But a couple questions from last week as well. So we'll go over, as we always do, the material that you'll need to know for the test as far as the topics that are covered. That'll probably only take us the last 5, 6, 7 minutes at the end of class tonight. Quick review from last week. If you find yourself behind at this point as far as getting an assignment in, if you're stuck on that, let me know right away. If it's just a time issue, go ahead and get it in as soon as possible so I can give you the most points that I can. Good week on the discussion board. I appreciate that. Hopefully we'll have another good one this week. Remember, tomorrow night's the deadline for the first post to get full credit. We need a main post in by tomorrow night. And it always helps when I'm not just having a conversation with myself. It's a lot more fun to have you participate as well, of course. So I appreciate that. Stay diligent, of course, on the checkpoints. And like I say, I think if I recall correctly, you had a great week on the assessment side as far as the test. I think you scored 100% if I recall correctly. But if you have any questions as you prepare for the assessment this week or from last week's, let me know. All right, so this week, as far as the assignment is concerned, it's a case study problem. Not difficult. It's at the end of chapter 4, so it's a cash management case study problem. It gives you a scenario, and then it asks you 3 or 4 short answer questions. However, the instructions give you a word minimum, so make sure and be careful about that so I can give you full credit. But you're just going to want to give feedback on the case study based on the material from chapter 4, the products that it discusses, the cash management strategies that it discusses. So the whole point of the assignment, of course, if you're going to get 120 points, which is full credit, is to demonstrate that you can use the material from chapter 4 that the chapter is on that end of chapter question. It's a case study problem, so get into the information and try to put yourself in their shoes, and then give us some feedback on it, and make sure that you are absolutely answering all the part questions that are on there. Okay? But you can do it in paragraph form, or you can do it in short answer form, just as long as you've got your word count to get full credit and have answered all the questions that are on there. So that's this week's assignment. Should be pretty straightforward. Let me know if you get hung up on anything. But as I mentioned, it's at the end of chapter 4. It's number 9 under the case studies, the financial planning case studies. And it's an interesting situation. Like I say, hopefully you can put yourself in the person's shoes and give me some feedback and perspective based on the products and services that chapter 4 discusses in the ebook. All right, so that's the assignment for this week. The discussion board, I've already posted a few different things, but we're talking about, we talked about risk and reward last week, and we're going to talk more about investments and investment decision making this week, but specifically buying and selling stocks, market limit and stop loss orders, which doesn't have a lot to do with this week's 2 chapters, but it is interesting when it comes to buying and selling stocks to understand the different order types, the different ways that you can place orders if or when you might do that. Okay, so that's this week's discussion board. As far as the assessment, as I mentioned before, just 10 questions, and we'll go ahead and cover those topics at the end of class tonight. Okay, so just a quick overview on taxes before we get into the slides. Politically, and I know we're not in a political season now, Trump is in. We don't have an election again for quite a while. Even the legislative elections won't probably happen until this next fall. So there's not a lot of political, stuff going on as far as elections are concerned, but there absolutely is a lot of political content and feedback if you were to look on CNN News or MSNBC about tax and tax policy, because one of Trump's primary objectives as far as getting something done through Congress in the near term is tax legislation. And what he's primarily trying to do is lower taxes for corporate America and simplify taxes for the average American. There are a handful of other priorities that he has and that they'll, I'm sure, put together in a bill. But primarily, he campaigned on lowering corporate taxes and simplifying individual taxes. Now, simplifying individual taxes in many cases can mean getting rid of loopholes and deductions. When we talk about loopholes, we're usually talking about ways that people get credits and deductions off of their taxes. And many people say, yeah, close the loopholes, close the deductions, but mortgage rate interest and children credits and things like that most of us use would be pretty painful if those went away. So I just say that because there's always another side of the story, right? So if somebody's always saying we need to simplify taxes, well, part of that process is cutting out the things that help us save on taxes. And so you have to be kind of careful about that. It's definitely a balance. The other thing a lot of people will say about politically is that we always just need to lower taxes or eliminate taxes. Why can't we have lower taxes? We can't have lower taxes because our government spends a lot of money, right? And we all know that. They spend about a third more than they even make, right? And that's how we have so much debt and deficit. But on the 2/3 that they do make, that comes from our taxes. So it's a nice line to say, hey, we need to lower taxes, but the more important question is, where do you cut? Where do you cut programs in order to allow for taxes to be cut? So for example, if you say, I hate taxes at the gas pump, right? There's a lot of extra cost in taxes. Well, those taxes go to build a lot of the roads and highway construction projects around the country. So if you take away that tax, then you've got to find that money elsewhere in order to repair and build roads and maintain roads around the country. Another example, sales tax. Sales tax and property taxes within most communities help to pay for education costs. In fact, most of education costs come from local and state taxes, and sales taxes and property taxes are local and state taxes. And so if you want to cut those significantly, we're talking about making reductions somewhere in education. If you were to cut federal income taxes and federal corporate income taxes, that also sounds very nice. But primarily, the costs that our government are covering with those taxes, the expenses of defense spending, and some education spending, and healthcare. So if you want to reduce quality of healthcare, and if you want to reduce quality of our national defense, then you could in turn find ways to save money and hypothetically or theoretically be able to reduce taxes as well. So the only reason I bring that up is because it's not like the government taxes just for the sake of taxing. I think a lot of people think, well, they're so corrupt and there's so much bureaucracy and so much red tape that we could just cut taxes and make the government more efficient. That's an okay line. It's almost impossible to accomplish that. And so what needs to happen if you're pro tax cutting is, on the other side of that, you either need to come up with programs to cut and find ways to reduce spending, which is really difficult for government to do because every program out there is really important to someone or to many people, right? So if you cut healthcare, or if you cut education, or if you cut defense spending, somebody's getting hurt and impacted by that, right? If not a group of people or even the whole country. So taxes play a very important part in our country's well-being, in our country's economy. Most of the services that taxes provide for uh, private entities and individuals aren't willing to do. So, for example, in a neighborhood, most of us would not put up street lamps and maintain the roads in our neighborhood out of our own pocket. And in fact, we wouldn't even work very well with our neighbors in doing that. So government has a place in doing that. Most of us would struggle to educate our own children if not for the public education program, plus charter schools, plus homeschool programs are all subsidized and paid for in large part by taxes. A lot of healthcare is paid for by taxes, Medicare, Medicaid. So anyway, there's just a lot of what happens in this country as far as quality of life and care that is provided for through taxation. All right, so that's the primary function of taxes, and those are some of the arguments about taxes. We should just simplify and we should just lower taxes. But we have to be careful about, what we're really saying there. If we're simplifying, like I say, we're probably getting rid of deductions and credits that are important to a lot of people. And if we say lower taxes, we're getting rid of revenue that needs to be compensated for in some reduction of benefits or spending through the federal government, which also would in turn affect, if not a few people, many people, right? And the well-being of a lot of people. So it needs to be a more balanced conversation. It can't just be blanket statements. Hey, simplify and cut. That's fine. What are you going to do on the other side? To make sure that you are aware of the things that you need to cut in order to allow that to occur. Or you could stand for higher debt and deficits. And I don't think any politician in their right mind is truly campaigning or has their stand, their platform is based on increasing the national debt. I think most people, and Democrats and Republicans alike, agree that that's not savvy. That's not prudent. That's not what we should be doing. Both sides are trying to be more financially and fiscally responsible. It's just that both sides are doing a lousy job of it. And at this point, like I say, our government spends about a third more, and we're talking hundreds of billions of dollars, but about a third more than what they bring in tax revenue they spend. So that's why we go into debt each year. It's like having a neighbor that spends way more than what they make on toys and fun things, and then at some point there's a price to pay, right? Some point they go bankrupt, they lose their house, something happens, because it always catches up to you at some point unless you change what you're doing and change your lifestyle and do something different. The whole Dave Ramsey thing, right? You gotta change everything about your lifestyle in order to get on track when you're spinning out of control like that with debt. And that's where our country's at. So as far as taxes are concerned, a little bit of a soapbox there. So let's get to federal income tax. Federal income tax is one of the most popular taxes, most common taxes, most punitive taxes as far as how much people have to pay. Most times it's withheld from your paycheck. Okay, so a lot of people don't even feel like they're paying federal income taxes. They get a return every year, but that return every year is usually based on them overpaying, and a lot of your paycheck, if you'll look into the details on it, ends up going to taxes. The Internal Revenue Service, or IRS, of course, is the administrative and enforcement associated with taxes. Typical American family pays more than a third of their gross income in various taxes, everything from sales to gas to property, to, of course, income taxes. But there's all kinds of different taxes that you end up paying in the end on your money. A couple different tax structures: progressive and regressive. Progressive taxes mean the more you make, the higher percentage you pay. Our country's income tax rate is a progressive tax, meaning the more you make, there's what's called a marginal tax rate, which means the more you make, the higher the rate of taxes that you pay. So if it was a flat tax, that would mean that everybody paid the same percentage, but if you made more, you'd pay more, right? We don't have that. We have what's called a progressive tax, where the more you make, the more percentage you pay too. You don't just pay more because you make more. You actually pay more than you even would normally, because the actual rate goes up. So you might pay 15% in tax, and I might pay 39.6% in tax. I might pay double the percentage, even more than double the percentage, and on a higher amount, right? So exponentially higher amounts in tax. So here's an example of a 2010. This is old. Like I say, the highest bracket now is 39.6. That's marginal tax rates. Here's some different filing statuses. Most of you are familiar with these. Usually married filing jointly or single are the two that help people, you know. Married filing jointly actually has some nice advantages in the tax code. Almost everything else is not as favorable. And you know, don't ask me why. That's just how it's set up. Taxes are due on a pay-as-you-go basis. That's why employers are mandatorily withhold some of our income for taxes. However, individuals can always choose not to withhold anything and then pay everything at the next year. The only downside of that is if the IRS were to see that you're doing that, they could technically fine you and penalize you for not paying as you go. A lot of people wonder why small business owners pay quarterly taxes. It's because it's a pay-as-you-go format. They have to pay as they go, just like you and I do if we work for someone and that person withholds every month, or that company withholds every 2 weeks every time we get a paycheck. All right, you've got income. Different kinds of income get taxed differently. So if I have capital gains on an investment, that's a very different tax rate at 15% than perhaps my wages. That could be as high as 39.6. Passive income is a different whole format. It gets taxed a little bit higher than capital gains. And as far as losses are concerned, only passive losses can be deducted from passive income. So if you have a real estate investment, right, rental properties, and you lose money on your stock investments, you can't write those directly off from, you know, at unlimited levels. You can't write those off from your gains on your real estate, okay? Because passive income is different than active income. Or you can't say, okay, I'm going to take my wages, right, and offset all my passive losses every year. You're capped at how much you can lose. So there's lots of different rules. So you come up with your gross income, then you get to your taxable income after your personal exemptions, then you take out tax credits. Okay, you actually put, you know, you get the advantage of tax credits, and then you get to your tax liability. Just as a side note, tax credits are a dollar for dollar savings in taxes. Tax deductions are absolutely not dollar for dollar. So tax deductions reduce my income, my overall income, but they don't reduce my tax they do reduce my tax liability, but not dollar for dollar. So for example, mortgage interest, excuse me, deduction. Depending on my tax rate, I might save $1 in $5. You know, I might save 20% in my overall tax bill based on a mortgage interest rate deduction. But if I get a child credit of $2,000, that's $2,000 less that I have to pay in taxes that year. Okay, so deductions and credits are different. Credits are more valuable for each dollar. Deductions, there are a lot more deductions out there and can be very powerful when added up, when itemized and added together in the aggregate as far as decreasing your overall taxable income. Capital gains are important. We've got long-term capital gains and short-term capital gains. Short-term capital gains are sub 12 months. Long-term capital gains are more than 12 months. Just keep in mind that the rate difference between those can be substantial. And so if you bought a piece of property, or if you bought a car, or if you bought a piece of art, or if you bought an expensive coin or a collectible of some kind, or even a stock or bond or mutual fund, and you go to sell that inside of 12 months, you'll probably pay a lot more tax on that than if you would have waited 12 months or longer. So it's always something to keep in mind when you buy anything that you might turn around and sell later, because whatever you sell technically should have capital gains tax associated with it. And so we want to try, if possible, and I know it's not always possible, but if you're close, or if you can get to 12 months, that might save you quite a bit of money in taxes to wait. Okay. So if I'm selling something here in Utah on KSL, which is kind of like a Craigslist here locally, and it's a car that I bought 10 months ago and somebody wants to pay me more than what I paid for it, I might consider just waiting till 12 months in order to sell it. Okay. Because it would save me a few bucks in taxes. Here's some deductions that you can have. You've got a standard deduction that just is based on your filing status, age. Then you've got itemized deductions. And itemized deductions like charitable contributions and mortgage interest are some big ones here in Utah, at least, that people usually they end up itemizing. They don't usually end up taking the standard deduction. There's a lot of people who give a lot of money to charity here and around the country, obviously everywhere. But if you give a lot to charity and you also have a mortgage, it'll probably make sense to itemize instead of taking the standard deduction. You'll want to take the higher of the two in order to reduce the taxes that you'll pay. You have exemptions based on your age and how many children you have. And then you get to your reportable taxable income. Okay. Then you take out your credits. Excuse me, you take out the credits that you have. So if you had $375,000, you're probably going to pay about $100,000 in taxes. So you begin to understand why somebody who makes a lot of money becomes laser focused on trying to reduce their taxes, where somebody who doesn't make as much, they don't get too excited about it. Although they're still paying quite a bit. So somebody who makes $30,000 a year might get, $3,500 in a tax return, in a tax refund, because of different credits and deductions that they have. So we already talked about credits versus deductions. Credits save more because it's actually a reduction in the actual tax owed, where deductions are just a reduction in your total income. That does become taxable, but it's not the actual tax itself. 1040 easy. If you're under 65 and have income under 100,000, you can do a very simple, straightforward return. TurboTax, Tax Act, and others. Lots of different softwares out there that are really easy to use. Just walk you through it. But if you fall into this camp where you've got under 100,000, you don't run a small business, you don't have a lot of deductions, life is pretty straightforward, financially anyway, then you might want to consider, just doing your own taxes, because it's pretty straightforward. Or, if you don't believe me, go to a place, pay for it 1 year, and then the next year just, look at the PDF of your filing from the year before so that you make sure and do it right. But I think what you'll find is it's really straightforward and really easy in most cases. Now, if you have rental properties, if you have a small business, if you have a lot of different investments going on that you need to report, like trading stocks or something like that, then you might want to consider getting some help, because they can, usually just because of their knowledge and experience, they can leverage you and take less time doing it. You still have to provide them all the same information, though, that you would if you did it yourself, of course. So it shows you an example of the form, shows you an example of different answers. We talked about how quarterly payments, if you get estimated income from being self-employed or from other income, they'll force you to make quarterly payments. April 15th is the deadline for the prior year. We know that. Of course, you can file for extensions, but you pay an interest penalty if you do that. You can go back and amend returns if you've got problems with prior year returns. And you can have your returns, of course, audited. And this isn't when the IRS comes and audits you. This is what they're talking about here, is that, if you feel like you need it, you can pay for, somebody to come in and audit your returns. Almost all, well, actually all financial, like the S&P 500, made up of all the 500 of the largest companies in America, they all get their tax filings and financial information audited. So what that means is a third party comes in and reviews their books and checks for errors and problems. Most of us don't need to have that happen. So of course you've got options on how you can file, but in the end, whether or not you have somebody else file for you or not, you are responsible, right? If the IRS comes after you, whoever helped you do your taxes, no matter how good they are, if you didn't give them accurate information, they're going to point the finger right back at you. Tax avoidance is legal. Tax evasion is not. Something to just keep in mind. Every tax class I've ever had, and I've had probably a dozen different tax-related seminars or classes over the last 15 years. Every single one of them has this mantra of avoidance versus evasion. Avoidance is legal, right? It's where we legally try to reduce our tax liability. Evasion is where we illegally lie or try to evade our responsibility to pay what we're supposed to pay. Okay, and of course evasion can have you land in jail. It can get you fined, all kinds of fun things that tax evasion can create a problem. Different ways that tax evasion can create problems, excuse me. All right, so that's enough on taxes. Let's move to managing your cash and savings. All right, so for many of you, managing your cash and savings is kind of a moot point. What you do is you get paid every 2 weeks, you spend whatever you get paid on living, right? Just trying to exist, trying to pay for food, rent, car insurance, cell phone bill, cable bill, all the things that we have to do, right? And so maybe right now you might not feel like you need cash management help, right? Or banking help, basically. But I would encourage you to consider it, even if at this point you're not using like a checking account or not using like a savings account or different programs that the bank has and offers for free, right? Or online offerings that are out there that are for free that help you with cash management. I'd encourage you to consider some of them. Some of them can make your life easier, can save you time, and can even save you money. And sometimes help you to more successfully manage the inflows and outflows that you have each month, and especially help you to be able to save a few dollars for the future. If you cash your check, bring a pile of cash home, and spend it all, and even if you have budgeted, and even if you have a certain amount of cash that you think you'll spend, and then you should have some left over, even subconsciously, most of us spend whatever we have. And so if you've got that pile of cash in your wallet, it's a lot more likely that you'll spend it, right? But if you have some, online tools and some different things that you're using to manage your money, there's can be a better likelihood of success as far as saving money and trying to stick to a budget of some kind. All right, so why do we even care about cash management? The day-to-day use of our cash is part of almost all our lives, right? We have to pay for food, we have to pay for wherever we're living usually, we have to pay for transportation, we have to pay for insurances on different things, we have to try to save for the future. Some of us have children that we have different obligations and payments for. So there's just always, this money and transacting issue associated with our lives. And any way that we can make that easier or less stressful is a good thing, right? So liquid assets include cash, checking, savings, money market, CDs, treasury bills, and savings bonds. Most of you are familiar with cash and checking accounts. Some of you are not familiar with savings, money market mutual funds or deposit accounts, CDs, treasury bills, and treasury bonds. Having said that, in my world, in the world of banking, I rarely see T-bills or savings bonds anymore. They were much more common historically, that people would just buy savings bonds. I do see quite a bit in CDs. That usually gives you a higher interest rate where you tie up the funds for a little bit longer, like 6, 12, 24 months, 60 months, something like that, and they give you a higher interest rate than a normal savings account does for holding your money over time, and then they penalize you if you get it out early, so it has to stay there, but it gets you a better interest rate if you keep it there. And then of course a checking account's pretty straightforward. It's a way to transfer money either through a debit card or through checks or through online bill pay or through automatic ACH payments. A lot of different ways through a checking account to be able to transfer and transact with your money. Then, of course, cash is king, right? So today's financial, services marketplace is pretty complex. There's a lot of different products, right? Mortgages, insurance, mutual funds, credit cards, normal banking like checking and savings. But there's also things like tax preparation, financial planning, securities where you buy or sell stocks, real estate, trust, estate planning. There's a lot of different issues associated with our financial service, with our finances, right? With our money. Primarily what this chapter is focused on are these financial products on the left, and more specifically, checking and savings and different products that allow us to move our money. You've got depository instruments like commercial banks, savings and loans, which you don't usually see now, savings banks and credit unions. So here in Utah, we've got banks like Zions Bank, Capital Community Bank, Central Bank. Those are all different examples. Rock Canyon Bank, and then we've got a lot of credit unions like Mountain America Credit Union, America First, and wherever you are, I'm sure you have banks and credit unions. Those are the two most common financial institutions now. Post 1994, S&Ls or savings and loans have kind of become less common. And then you've got non-depository financial institutions like mostly investments and insurance. So stocks, bonds, mutual funds, life insurance companies, like big life insurance companies. These are financial institutions, but they're non-depository, meaning they don't have branches all over where you go and deposit your money and then they pay you interest or try to help you manage your finances. Commercial banks, the largest type of financial institutions. These are banks like JP Morgan Chase, Wells Fargo, US Bank, Key Bank. Just you think of your big ones like Bank of America. Those are all large commercial banks. They offer large loans to very large companies in many cases, but they also offer loans to you and I, as individuals as well, with mortgages, cars, credit cards, things like that. And they also do usually a pretty good job on the checking and savings side, making it easy, making it mobile, making it online these days. S&Ls, like I say, not so common. We're not going to spend a lot of time there. Savings banks, not as common still. Credit unions are very common. Basically, credit unions are a variation of banks. Credit unions usually offer a little bit more interest. They usually don't have stockholders, so they don't have to answer to different shareholders or stockholders. As a member of a credit union, you're technically part of the ownership, even though you have little or no power based on an account. But it gives you the opportunity to many times get a higher interest rate on deposits and a lower interest rate cost on things like car loans in most cases. So credit unions and banks both have federal protection. You'll probably be familiar with the term FDIC. That's the Federal Deposit Insurance Corporation. It was set up after the Depression when a bunch of the banks failed. Used to be 100,000, now it's 250,000 of FDIC protection, where if the bank that you have your deposits at goes out of business, goes bankrupt, the FDIC will come in and write you a check for up to $250,000 to make you whole. We had back in 2009, 2010, two different banks here locally in Utah County go out of business. One was Centennial Bank and the other was Barnes Bank. Those two banks both went out of business and the FDIC closed them. It's usually a temporary close, and then when they reopen, the FDIC manages checks out to all of the depositors of the bank. If you have more than 250,000 or have not got multiple, different registrations that get up to $250,000 of coverage, and you have more than that on deposit, you stand to lose money. Because when a bank goes bankrupt, they don't have enough money in the first place, which means that if you have over 250, you're not going to get your money. Okay, so it's always important to make sure that you've got FDIC or NCUA coverage of up to 250,000, and it's also important to, if you're going to hold more than that, that you just work with good institutions, banks that are solid, on solid footing, or credit unions that are solid, or that you spread your money around. So those are your two options if you have over 250. But there are people like Warren Buffett and Richard Branson and folks who are billionaires. It wouldn't make any sense for them to go around and put $250,000 in every single bank around the entire world. So what they do is they just bank with the safest institutions they can find, and they don't worry about it because it's highly unlikely that if you're with a very, very safe institution that it will go out of business. So a little differences between those different entities, kind of lines them out. I've given you examples of all of them, except for S&Ls, which, as I mentioned, aren't common at all anymore. Then if we look at a checking or savings account, a checking account is also referred to as a demand deposit, and a savings account is also referred to as a time deposit. Demand deposit, checking accounts mean that it's usually your put and take account, money that you're always actively putting and taking from the account. A savings account is usually an account that has less frequent transactions and is meant to be longer term money. Doesn't mean it has to be, but it usually is, and usually pays us a higher interest rate. In today's world of identity theft and fraud, it's very common. Checking accounts are more susceptible to those types of things than savings accounts. Checking accounts fall prey to identity theft and fraud a lot because they're an easy target if somebody has a debit card number or if somebody has your account number, that they were able to get from one of your checks or through just, hacking something. They can easily go and try to make transactions happen online or even in person at stores and things like that. And it's hard to detect and track those individuals that are doing that. Most banks will protect you from those types of things and make you whole, but sometimes it takes time and there's a real high hassle factor sometimes with having to do that. So you have interest-bearing checking accounts and you have non-interest-bearing accounts. A lot of times people will say, well, why would you ever want an account that doesn't pay any interest on a checking account versus one that does? And, if you were to go around and research out how much interest these interest-bearing checking accounts actually pay, I think what you'd find is it's almost negligible. It's almost like they don't even pay anything, and it would almost be better if they just kept the checking account pure, a pure checking type product, and then just paid more on the savings account. I think most people would appreciate more interest on their savings account, especially now with how low interest rates are. And then you've got, as far as financial accounts are concerned, you've got what's referred to as an asset management account, or what we refer to at Zions as a wealth management account. These are the types of accounts that I work in and do every day as a financial advisor for Zions, where I set up an investment program, a strategy for accomplishing higher returns over time. But I also have to be very careful about the risk that people are willing, it's a risk-return trade-off like we had talked about earlier, to do that kind of thing. So, but we can invest in CDs, we can invest in mutual funds, ETFs, exchange-traded funds, stocks, bonds, whatever it is that we want to invest in. Two different types of money market accounts. You've got the depository kind from the actual institution. A money market deposit account is just a glorified savings account. Sometimes it pays a little bit more interest. Right now, money markets don't pay more interest than savings accounts in most cases. And then you've got money market mutual funds, which are similar to other mutual funds, except in this case, they're just investing, they're pooling the investors' money and then investing in ultra safe instruments. That 1 to 3% above regular savings quote there on the right side is absolutely false right now. This is an old slide, but this is based on history from 5 years ago. Over the last couple years, money market mutual funds actually have paid less than savings rates at banks. The reason for that is that they're investing in these money market mutual funds in short-term government issued instruments like treasuries, and short-term government issued issuances like treasuries have actually been paying less than the average savings account in recent history. So if government debt and bonds are paying really low, then sometimes savings will be higher than a money market mutual fund. And in current times, that's where we're at. It's kind of an odd thing, but that's what's happening right now, is that you actually make more in a savings account than you would if you were to invest in a money market mutual fund. And then banks, of course, have a lot more electronic services now than they ever did before, but the EFTS system, the ACH system, mobile systems now allow you to do all kinds of transactions without ever, writing checks or without ever having to even meet with someone, which makes things a lot more convenient, but it also makes things a lot more susceptible to fraud, as you can imagine. 1978 was a long time ago, but basically an act came into existence for banking to be able to regulate and watch after errors and issues so that they could track and prevent problems. Now things happen so fast that a lot of those rules and oversight that they put in place back in 1978 doesn't work the same way now, but that was kind of the original construct, or kind of framing for what we have now in our banking system. Other bank services that are popular: safe deposit boxes. Maybe you've seen at the bank, inside of the vault at a bank, they'll have all these boxes. You have your own key. You could keep financial documents, cash, coins, whatever collectibles inside of those boxes. And then you've got a safe place that's always locked, that nobody can get to hold, something that's important to you. I think they're a great tool, actually, to for a little while I would put a hard drive with all our with all our pictures on it, because if our house burned down, we'd lose everything. Now, because of cloud services, there's a lot more ability to back up and do other things. And but people should keep stock certificates and titles, and maybe even passports and different official documents that would be difficult to replace if they were lost, or if something happened to them, if they're in a centralized location like a bank safety deposit. And usually banks will charge you on an annual basis for a safety deposit box, but it's really cheap usually. And sometimes if you've got, if you're a good customer of the bank, they'll just give you a free safety deposit box if you request one. And then many banks will offer trust services, not that they write trusts. Most banks do not write trusts. Attorneys write trusts, but that they offer what's called trust services, which is if you in your trust put down the bank as the successor trustee. So if I open the David Shipley Family Trust, the David Shipley Family Trust has myself and my wife as trustees, but instead of having one of my children be a successor trustee or one of my siblings, I can have a bank act as the successor trustee, and then they very professionally take all my assets, if something were to happen to both of us, and divide them among whomever I put in my trust. That way it's a non-family situation, so that a sibling doesn't fight with another sibling over how they take care of the trust. It does usually cost, obviously, to use a bank for trust services, but if it's like 1% of the estate, many people would say that would prevent a lot of problems that can happen between family members if a bank is acting as trustee instead of a family member. But just preference thing. Most large estates will have a large bank act as trustee to keep their family from having problems and suing each other over every little part of what happens. So I talked earlier about that I do think it's a relevant consideration to consider, instead of being a cash only type of person when it comes to transacting and cashing your check and all that kind of stuff. Consider having a checking account, but always obviously consider all the fees and costs associated with it. The days of 100% free checking are ending. Meaning most checking accounts have some sort of fees associated with them if you don't jump through certain hoops to do certain things. Some banks will give you a free account if you have direct deposit. Some banks will give you a free account if you have enough on deposit. Some banks will give you a free account if you pay certain bills through them. So if you can find an account that you're going to do whatever they're going to have you do anyway, it's not out of your way or a big inconvenience to you, then I would consider those banks first, so that the account will truly be free or at least very low cost. You have to be very careful, obviously, on bank accounts that you keep track of what you're doing. If you overdraft, it can be a very expensive situation. Every year at the bank, we have people come in that have gone to a gas station to get a soda, or they've gone to McDonald's and picked up a few hamburgers or something like that. And just for a few bucks of charges, they've overdrawn their account because they didn't have enough money, and the bank will charge them $30 or $40 or $50 for every one of those charges. And those fees can rack up really fast if you're not careful. So you have to be careful about how you use a checking account. It can be dangerous if you don't use the checking account responsibly. Different kinds of checks beyond just regular personal checks. There's cashier's checks, traveler's checks, certified checks. So different ways that you can, again, transact money. So some people, if they buy something, for example, from somebody they don't know, instead of allowing them to, instead of using a personal check, which a lot of people don't trust personal checks because somebody can write a personal check even if they don't have enough money, and then you're going to be out the money. So if somebody pays you $5,000 for a car and writes you a personal check, and then you go to your bank and put it in your bank will take it, but then 2 days later when they try to clear the money, it's going to bounce, and you're going to be the one stuck holding the bag. Not only do you not have a car, but now you don't have the money either. Okay, so you have to be very careful about personal checks. A lot of stores now, a lot of places that used to accept checks don't even accept checks because of the problems that they ran into with people bouncing them and costing a lot of money. So if you're selling something online, or if you're selling something face-to-face and the person is not going to give you cash, potentially you could request that they give you a cashier's check. The only problem with cashier's checks is that a lot of cashier's checks, although they look official, can be fraudulent. And so what I would encourage you to do if you're making a larger transaction with another person, for example, for a vehicle or a camper or a four-wheeler or something like that, if they're going to pay you in a check or a cashier's check, I would have them meet you at their bank and have the bank verify that it's a valid check before I would ever give them whatever it is that you're selling. Because we see a lot of fraudulent cashier's checks. So just be careful on that. And if you're selling something, and if anybody offers you to write you a cashier's check for more than what you're offering, just shut it down. Don't even visit with that person. They're absolutely trying to defraud you. There's a lot of fraud that goes on online when people try to sell things because people offer more than what it's worth, and we think, oh, that's too good to be true, and alarms are going off in our brain, but we still accept it. We ship the product, and by the time when the product's completely gone and the bank finds out that we cashed a fraudulent cashier's check, then we're the ones that lose the money, and we're also out our product, and we'll never be able to track it down because that person's long gone, right? With whatever it is that we sold them. So just be very careful when it comes to these types of checks. Obviously, when it comes to saving money, most of us have to figure out a system that works for us. Most of us naturally are not very good savers. As I mentioned earlier, normally, and this is what I see when I visit with people as well, we are very good, at spending about what we make. It's amazing how fast, somebody after getting a raise is already spending that extra money. Sometimes we'll sit down and think, well, if I only made $3 an hour more, or if I only made $20,000 a year more, and then we make that, and it doesn't even feel like we're making any more because we just automatically, even subconsciously, spend that difference, and just in gradual things that we don't even notice sometimes. So how do we get around this? We set up a pay yourself program that's automated. So instead of allowing ourselves to try to rationalize and say, well, if I'll try to be a good I'll try to be good this month and save money. So, and try to be good all month. So at the end of the month, I'll have extra money so I can save. 9 times out of 10, we're not going to have any money left at the end of the month. We just already should know that about ourselves. So what we should do is pay ourselves first, save first, get it out of our account, and be disciplined about that. Even better, make it automatic. So all banks from their checking accounts have programs where they can automatically shift money to a savings account for you. And so if you're getting paid into your checking account direct deposit, let's say it's $1,000 every 2 weeks, then I would have your bank transfer, at least a couple bucks, if not more, every 2 weeks into your savings account automatically, so that you're automatically paying yourself first and don't even have to think about it. And definitely don't rationalize and say that you'll wait until the end of the month, and if any money's left, that's what you'll save. Because I'm just telling you now, there are very few people that I ever meet with, no matter how much money they make, that ever have money left at the end of the month. It's amazing how much people can spend, no matter how much they make. Okay? And obviously you want to try to get some interest on your money, and then there's different rates associated with interest that you receive. Compounding interest is the best type of interest, because the interest that we receive then gets additional interest on top of it, where simple interest just pays us an interest rate based on our original balance forever. So it can't grow nearly as fast over long periods of time as compounding interest does. Okay, I think that's all I want to cover on cash and cash management products. Let's go ahead and take a look now at what will be on the test. So 1 second. That was loud. Okay. So question number 1 on the test, you need to know about which tax, and we alluded to this early on in tonight's discussion, but which tax provides the majority of the government's revenue. Okay, so the government has all these different taxes. We talked about that, but which one of the taxes that we pay provides the majority of the revenue, the tax revenue that the federal government gets? Okay. The next question is the difference between progressive taxes and regressive taxes, or flat taxes. Those are the 3 different taxation types. We talked about how the income tax rate in the United States is a progressive tax rate. As long as you understand basically what a progressive tax is, you'll get number 2 right on the test. Number 3 on the test is about tax planning. What does the book have to say about tax planning? Is tax planning something you just do every year in April when you file your taxes, or is tax planning something that you do throughout the year? Find out what the book says on that, and you'll get that one right on the test. Number 4 on the test has to do with Social Security taxes. Make sure you understand whether or not an employee, an employer, or both are the ones paying a tax for Social Security. You probably see Social Security tax show up on your statement, so I've already given you that part. But does an employer also pay a part of Social Security tax or not? So understand that before you get to the test. It is very clear in the tax chapter whether or not employees, employers, or both pay Social Security tax. Number 5 on the test is the risk-free rate of return. How do we measure the risk-free rate of return? That is a question from last week. Number 6 on the test, why do we use mutual funds? It's also from last week. Why do we use mutual funds? We talked about various reasons we use mutual funds. Make sure you know what the book lists out as the primary advantages of mutual funds, and then make sure and have those noted before you get to the test. Number 7 on the test is a question about stock dividends. So if you receive a cash dividend from a stock, how is it taxed? So that's the chapter on tax. How are stock dividends taxed? Make sure you understand that before you get to number 7 on the test. Number 8 on the test, it's actually this slide that we're looking at now. If you understand the information that's on the slide that we're looking at now about establishing a savings program, you'll get Number 8, write on the test. Number 9 on the test, know the difference between a checking and savings account. And number 10 on the test, make sure you understand what is a certificate of deposit, or CD. If you understand those, then you'll get all 10 questions right. Pretty straightforward this week, not difficult questions. None of them are tricky. All of them are straightforward. I think you'll do great. You did great last week. I think you'll have another good week on it. But if you have any questions as you review the information that we've gone over tonight as far as the topics, just let me know if I can clarify any of them. But if it were me, I'd just read through chapters 3 and 4. I'd briefly look specifically for the content that I told you is repeat from last week on mutual funds and on the risk-free rate of return of interest. And if you've got those two from last week, and then you've looked over 3 and 4, you should be in great shape this week. All right, that's all I've got for tonight. Have a wonderful week. Let me know if you get stuck on anything, and good luck. We'll talk to you soon.